Uh, I'm I'm an investor, so I invest as an angel investor as of now. So
Okay,
one of the startup I would like to mention is Zapfresh, where I'm an early stage investor, and it is going for an IPO probably
okay,
this month. And
great.
along with that, I have also invested into four other startups. So one of them is in your portfolio, which is Garuda.
Oh, great.
So totally, I have invested into five as
Okay,
of now.
okay.
And at the same time, I am building my own startup. So I'm a founder as well.
Oh, great.
So that is still in sleep mode. So this is about me. Thank you.
Great, Mukesh.
Hi, Neeraj, Mukesh here. I hope you guys are able to hear me.
Yeah, yeah, very well, Mukesh.
So, Neeraj, after 22 years long stint at Wellspun, I was a CEO at Wellspun,
Okay.
Wellspun Floorings. I decided to step out and start something on my own.
Uh-huh.
And I'm a founder for a food health-based food startup, Nutrisum.
Hmm.
And we are 5 months into our journey, wherein we've launched healthy cookies, healthy rusk.
Okay.
Our motto is no sugar, no maida, high fiber. Essentially, uh, packaged foods, convenient foods for people suffering through diabetes, suffering through blood pressure, and heart health issues. So I'll just say I'm also an Harvard alumni.
Okay. Great.
And the guy who's a co-founder with me is a veteran in this industry. He was ex-president of Epigamia.
Hmm. Hmm.
Also worked at Johnson Johnson and 2M. So for me, this is sort of an introductory call to into this world.
Oh, great. Perfect. So as you can see, I think both of you, I think 100 out of 100, if I can call it, are both founders and investors at the same time. And I think that is the trend that we are looking at, Kumardeep and Mukesh. And that is why when we created the tech platform, a platform called Invest that we created, which is just to connect the communities both in India and outside. So it's a dashboard driven kind of experience, and there you can join as a founder and investor at the same time, because we knew that there's a huge population of people who are switching the lines, very, very frequently, and they're building something, and they're also helping others to build ventures. Yeah. Anybody else who wants to take this moment? Okay, by the time other people are joining, to introduce yourself. I think all of you have the talking rights. Okay. A few more people have joined. So, Rohan, can you allow them also the speaking rights? Nishant is there. So is Subhakshini, Vijay. Yeah. So we are about to start the discussion. Okay. But I think we already started it. Okay. I'm just requesting any one of you can take this moment to introduce yourself. Okay. What you have been doing and building. Are you investing in startups or you're building your own startup? You can just share that. And I think that will help to have this conversation.
Yes,
Hi, Neeraj.
Yeah. Hi, Nishant.
Hi. I can give a quick introduction. So I'm an outlier in this group in that I have not invested in any startups, and I am in the nascent stages of building my own startup. And I saw this opportunity on LinkedIn, and I thought that this would be a good way for me to get an insight on how investors and the other side of the table thinks, so that when I eventually get to that stage, I can have a greater knowledge of how to essentially build my portfolio and present the opportunity to them.
Got it. Great. So welcome, Nishant. Yeah, Subhashini, I think you can go next. Yeah, please.
yes, I'm delighted to be here. Thank you for this opportunity. I have started with investing like around 2, 3 years ago, and I think I have built a portfolio of over 22 startups. And I have also invested in WeFounderCircle itself, the greater company. And I am delighted to be part of this journey, and I'm waiting for it to become unicorn just by itself. And I think that it's a very beautiful thing, because the combined intelligence and the way that the whole intelligence works and how you all evaluate the startup, the full experience of the team, the maturity, and I think the wisdom of whether this will succeed or not succeed, and that gut instinct is so strong that I'm hoping that all of us can pile on and take advantage of that collective wisdom. So I really appreciate it, and some founders are so doing such great work, and that to find them all across the country and to bring them to us is not easy. And I'm sure that all your events and networking, and it really helps, and it also helps each other, I think, because of the large portfolio you're able to connect us. So I think in all, it's a very nice, thriving ecosystem, and I'm glad to be part of it.
Thank you so much, Subhashini. I think people like you are our pillars. I think day one you have been supporting us. Good to have you here once again, Subhashini. And this is like a big moment for all of us collectively as a community, because having reached to a certain milestone, okay, and done something which nobody else has done till now, in terms of like setting up a platform, connecting so many people, making so many investments, 130 investments that we have made in last 3 years. We've been the most active investor in last 2 years in India, ranking #1. And now that we have launched the VC fund also, so it's a journey in itself, okay, and we are also learning, and community has been always the strength, okay. They are the guys like who are helping us. So very excited. Welcome everyone. Now that I think there's a lot many people have joined. So let me just kickstart this by setting up the context that why we are here today. The idea is to quickly summarize the journey, okay, that we have completed till now, both in terms of making investments and connecting the community and setting up multiple funds. Today we have 3 different funds. We have 2 angel fund, one for India, one for global investors and to invest in global companies. And then recently we have launched the VC fund also. VC fund also, we have both the India fund, and we have the feeder fund for that VC fund for enabling the global investors to invest in the fund. So technically 4 funds in 3 years, 130 investments, connected community of more than 13,000 investors. So that's some of the things that we are very proud of. And today idea is to talk about this big leap that we are taking as an organization, as a community, that when we are starting our VC fund, what is the opportunity for people like you who have been investing as an angel till now, and how collectively we can take advantage of the growing this trend, okay, in India. The ecosystem is growing, and I think with that, all of us have tremendous opportunities. So idea is to see that how we can learn together. As Subhashini has already mentioned, the collective wisdom is the right word, okay. It's a collective wisdom which is driving us and taking decisions. So without taking too much of time, let me just pull off a small presentation that will help us to structure my talk. I'll try to make it interactive, so I'll finish whatever I have to share in next like 15 minutes or so, and then I want to open the floor for free discussion. We can all contribute there. We can have our questions, and we can also share our experiences, both sides, okay, whether you are an investor or a founder. Okay. Also, just before we start this, Rohan, can you just launch a poll so that I know that, okay, what kind of audience that we have here, so that I can accordingly fine tune my.
Yeah, I'm launching the poll.
So this is just for introduction, just to know the audience well. So it just basically you have to click that what exactly what profile is closest to your profile. Yeah, so there is a poll that you can see on your screen. You can choose one of the option, so that we know that, okay, now whom we are talking to, and we will accordingly reach out to you also. If you have never invested, you can just share that. If you invested in 1 to 10 startups or more than 10 startups, if you have ever invested in any VC fund, I think that will also help us. We'll try to take your feedback and I think your experiences that we want to share with the rest of the people here. Okay. Right then, I think we are good to go. We have the poll. If you have not participated, please participate right now. And then we can move forward. Yeah. Great. So with that, let me just quickly start my part, and then I will open the discussion to all of you. So welcome once again. I'm on behalf of the entire WeFounderCircle team. We are 5 co-founders. We have 50 people team. I have with me my colleague Rohan on this call. Both of us are operating from Bangalore office. My other co-founders are in Delhi, Bombay, and Surat. And we all are now actually have started heading one part of our business. So we have today 4 funds, as I already told you, 3 deal flows. We invest in pre-seed, seed companies till Series A and Series B. So pretty much completed the entire early stage investing. Let me just show you basically what we have been doing till now. So the story so far is that this is where we are. What you see on your right is the VCC Circle industry ranking last year. And you can see we are on top with 103 investments last year. Out of these 103 investments, 70 were done directly by us and our community and our curation. And another 33 companies were funded by our syndicate network. So when I say syndicate network, it's a platform as a service and fund as a service that we are giving to other smaller networks who may not have their tech product or a tech platform to connect their founders and investors, and people who may not have a fund license. So they are using our fund structure to manage their transactions. So we are not using our technology and fund only for ourselves. We are also helping others to use it and to do the transactions. So that's the ecosystem. We have been ranking #1 in last 2 years consecutively. And on the bottom left that you can see, there are like multiple funds. So Avarnya is our VC fund. That is the one that we have launched. And I think we will be talking more about this transition. In the middle, you see Global Angel Fund and India Angel Fund. These are the 2 funds that we are using to make investments in pre-series A, seed, angel, that kind of deals, slightly more matured and product market fit companies, both in India and outside India. So Global Angel Fund is the fund that we are the only one who have this fund in the entire country, that we can make investments outside India. And we can also bring the global capital in India using this fund structure. This is something that we have set up in Gift City. And the last one that you see on your right is the logo of EvolveX, which is our accelerator funding tool. And we are investing in very, very nascent stage companies, pre-seed and pre-revenue and pre-product companies also. What we are offering in total, I mean, this is the length and breadth of our ecosystem. So we are offering right now technology platform, which is a marketplace for funding. So both founders and investors get a dashboard-driven experience, and they can connect with each other and make transactions. You can learn from others' investing thesis. You can connect with entire community just being on this. So this platform is known as Invest, INVSTT, invest.com. In the middle, you can see all those funds that I already mentioned. So on one side, we have tech solution, which is a marketplace. We give it as a white label to others also, as I already mentioned. Middle, we have funds, and then right-hand side is the community that I was talking about, that almost 60 countries now, more than 700 global cities footprint, 13,000 people. Bottom, you can see that we already made more than 120 plus. So that number is almost basically 130 now. 15 sectors in which we have invested, 13,000 investors. Total $32 million is what we have invested. And the total AUM, or the market cap of our portfolio, is more than $1 billion right now, 4 funds. And this is a stack of the companies. You can see from early stage to Series B, we have invested across these 15 sectors. as I told you that now not only us, but there are a lot of other Indian and global networks are using our fund and using our platform. So you can see a few of the names here, and more than 10 million of investment is being done by these partners, okay, these other networks, okay, using our fund and using our platform in just last 6 months. We have been actively being reported, and I think our founders are making us really proud, both in Indian and foreign publications. People have written about us, but that's our past. This session is actually to talk about what is a big leap that we are taking, and that big leap is the transition from an angel to a VC. And I just wanted to open that discussion to you also, because you have been also investing both as angel, and some of you have invested in VC fund also. So just to take your views also on how India is shaping up as a big startup ecosystem, and there are more and more opportunities for each one of us to participate at different levels. So before I get into this, I'm just taking, say, a very basic steps just to give a clarity that what is the regulatory perspective, how SEBI, which is the regulatory body in India, and IFSCA, which is the Gift City regulatory body for cross-border investments, how they have categorized different funding tools. So the entire alternative investment funds, and when we talk about alternative investment fund, these are categorized by SEBI into 3 different categories. So category 1, 2, and 3, as we call it. So category 1 is slightly smaller funds. These are used majorly for the startup investments. But they also have infrastructure funds, angel funds, venture capital funds, and social venture funds. The major focus of these funds is to invest in startups or in innovations. These are typically small investments, especially the angel side of fund. They typically invest, say, small amount, and their total fund size is also smaller. Venture capital funds are like large funds. Then the category 2 is where we are talking about big money. So you have fund of fund. These are the funds which do not invest directly into the startups, but they invest in the other funds and take a indirect route of investing in startups. So fund like SIDBI, which is a fund of Government of India. So Government of India has allocated 10,000 crore actually to SIDBI, and SIDBI is making investment from that to different funds. Similarly, SBI has their fund of fund. A lot of corporate VCs also have their fund of funds. So corporates also set up a fund, and from there they invest in different funds rather than directly taking investments into the companies. You have debt funds and private equity. Private equity again is large funds. They come at a very growth stage into the companies. And right hand side is the category 3, which is slightly more open, and I think larger investments in infrastructure, in hedge funding, and public equity funds. So this is primarily the construct of how SEBI has classified. So for the interest of our discussion, I think we are focusing on the category 1, where the angel fund and the VC fund comes in. And to give you more insight on these 2 funds, this is the difference. In terms of source of fund, VC fund raise capital from institutional investors. When I say institutional, this is both individuals and institutions. But these are slightly more accredited investors, more matured investors. On the angel side, it's a personal wealth that you invest as an individual. Investment stage, angels typically, you can see and read yourself, so I don't have to read it. But angels typically invest in very, very early stages companies. And VC these days have started both in early to mid stage and then growth also. Investment size, I told you, typically basically this few $100,000 to, like, for example, we from our angel fund invest anywhere from $200K US, which is like 1.5 crores to $1.5 million, which is around, say, 10 to 12 crores in companies. Somebody was mentioning about Garuda. So Garuda is one of those investments where we have made around, say, $1.5 million put together in one single transaction. So that was one of our like bigger checks, but our average ticket size is 250K, which is almost like a 2 crore in a single transaction. And VC fund is where I think now that we have also launched, and most of the VC fund typically do multi-stage investing, that once they invest in a company, they keep on reinvesting in the same company. So start with the smaller checks and then keep on increasing. That is the strategy of VC funds. Angel fund, on the other hand, do not invest more than, say, maybe 2 or at the most 3 stages. And then after like 2 investment stage, they typically depend on the external money. And that is why I think the exit strategies also, in angels case, the angels are dependent on the VCs for the exits. And VC themselves wants to be the last man standing in terms of the growth of the company. Once they invest, they tend to go to the very, very growth stage of those companies. And typically IPO and acquisitions are more of a exit strategy for VC fund, or it is a acquisition of the fund itself from a different fund. So fund of fund also at times acquire the VC's portfolio. So that's how the acquisition happens. One of the important part is the involvement part. Okay, that's very critical in this slide. On the angel side, typically you can have a very strategic approach to your investments, where like you want to work with the founders and not just passively invest. VCs on the other side are very hands-on, okay, when it comes to involvement, because they want to exercise the control and tracking, because their stake is bigger, their investment is bigger, and they take board seats and they try to exercise the right of check and balances. So they put a lot of reserve matter rights to themselves, so that they create boundaries that how much decision founders can take on their own, and how many decisions, or basically decisions which are slightly more strategic and involve more money, all those decisions they have to take consent of the VCs. So VCs comes basically with that kind of mindset. So with that, let me come to the now deeper basically insight of this discussion. Okay, this is typically a life cycle of an angel, okay, when they start angel investing. So people who are in this call, and that is the reason why we just wanted to check that how many of you have done less than 10 investments, how many of you have done more than 10 investments. So typically, this is how the a typical angel investor's journey starts. So in the first like 1 to 4 years, okay, so they keep on investing because it's a portfolio investment asset class. No matter which angel network you join, or if you start taking advice from the senior, okay, pro angel investors and serial investors, all of them will tell you that one of the basic fundamental of angel investing is to distribute your money among, say, 4 to 5 minimum investments in a year. And that means over a period of like 4 years, you can expect your portfolio to be 20, 25 companies. If you are active, then it might go as high as 50 startups portfolio. Typically, you start your journey with joining one network, and then over a period of time, you start with interacting and engaging with more than one network also. So typically, 3 से 4 networks में you start joining, and you start evaluating deals from different networks. इसी 4 साल में, I think one of the things that you can expect is that if you are very lucky, you can have, say, more than 1 exits. Typically, exits 1 to 4 होती हैं in year 4. If you are very lucky, sometime in year 2 and 3 also you can get some exit. But typical scenario में 1 से 4 exits, okay, from your portfolio. So as a result, what is the outcome that you can think of, and what is a bottom line, that your investment is roughly around, say, 75 lakhs to 2 crore, depending on your activeness and your ticket sizes. So typically people invest anywhere from, say, 2-3 lakhs as a smallest ticket size to as high as like 50 lakhs, okay, and even more in some cases, but that's a range. 3 lakhs to 50 lakhs, that's the kind of like ticket size investors invest. So depending on your bandwidth and your activeness, typically 4 साल का scenario कुछ ऐसे होता है that you have invested more than 75 lakhs to 2 crore in different companies, and you have a portfolio of 25 to 50 odd companies. Portfolio value, if you are very lucky and you are very selective and the market is good, तो total investment आप 4 साल में जितना करते हैं, you can expect 2 to 3x of that portfolio value. And this is basically after considering कि उसमें से कुछ company आपकी will completely shut down, they might die, But whatever is left, and I think some of those companies will be outliers, they will be performing okay at a very, very exceptional rate. So total मिला के एक ऐसा ही कुछ scenario होगा कि आपका 75 to 2 crores you have invested, and 2x of the portfolio value is what is the value that you can expect. And 30% of the principal realization, some of the people, because when you get exits, so you exercise that right, sometimes you don't take that exit. So well, depending on what is your appetite of risk and all, so that is the number that you can expect after like 4 years. And that is a time when you start taking a leap, okay? Because that is the moment when you start feeling confident about it, because it's been 3-4 years, आपने थोड़ा पैसा लगाया होता है, you have worked with founders, you have taken 1 or 2 or 3 or 4 exits, so there is a much more belief into the asset class, और तब आप सोचते हो कि अब मुझे बड़ा क्या करना है. And I think that is a time in the next like 3 to 4 years, these are the options, okay, in front of any angel investor, that they can either say upgrade themselves and take a leap into a VC fund and start becoming a LP, या फिर वो they can start their own network, they can set up their own family offices. तो वो एक जनरल ट्रेंड is there in the industry, or you start taking bigger bets, तो आप बड़े investments करने लगते हो, because by that time you feel confident of the strategy. You also try to do this, the big leap. उसकी जो motivation है वो मैंने ऊपर 4 मतलब I've written down that the motivation is to diversify, to hedge your risk, and to increase the possibility of bigger multiplier. And with investment in VC, you also get a personal branding, because you are graduating from an angel investor tag to a LP in a fund branding. So that also gives you a lot of recognition and among the founders, among the industry. So that's also is one of the motivation why people take that kind of leap. So till this stage, if there is any question in terms of the life cycle of an angel, or if any one of you want to like share your experience because you have been investing, I invite you to unmute yourself and you can share, and then I'll proceed further. Rohan, can you give rights in case somebody wants to share anything, or you have any question at this stage? Any one of you, if you want to share anything, or if you have any question on this slide, or the journey of a angel investor, and most of you are angel investors yourself, so in case you want to share that, what stage of your journey you are in, is it like 2 years, 3 years, it's like more than that? All of you have the talking rights, so you can just unmute yourself and can share anything that is coming to your mind.
I will also run the poll once more, because I see a lot of new people joining in.
You can also do that parallelly.
Neeraj, what does the LP stand for?
Good question. So I'm sorry that I've taken this liberty to write LP. So it's the limited partners in the fund. So these are the investors who invest in funds. So typical structure, Subhashini, is that people who are investors in a fund, in a VC fund, are known as limited partners. And the fund managers who operate the fund are called general partner, GP. So LP stand for investors and GP stand for the fund managers. So that's the difference.
Got it. Thank you.
Hi, Neeraj.
Hi, Deepu.
Oh, Neeraj, one question. You mentioned that you have suggested that individuals should join 1 to 3 angel networks at early age, right? But there is my observation that most of the deals are common among the all leading angel networks. So why to go about for, 1 to 4 angel network? Why we should not be pick to the 1 or 2 only?
So I'm not advising that you should join more than one network. What I'm saying is this slide is a typical journey of an angel investor. Typically, this is how people feel.
Okay, but not the recommended journey, right?
Not a recommended. I'm saying, looking back to my journey and the investor friends and the community that we lead, this is what I've felt, that people in 4 years time एक typically ऐसे कुछ एक portfolio scenario या snapshot उनकी journey का दिखता है that
Agreed.
invest in more than like 25-50 companies, they join 1 to 3 networks. I'm saying 1 to 3. At times they are just sticking to one network only because of the reason that you just mentioned. Ke deals are more or less if it is an exciting deal, it is going to all the investor networks and you don't miss it. So
And
look,
people also join other angel networks due to the quality of deals.
yeah.
That's
but
one more reason.
but I think Deepak is also right that most of the good deals basically they go to other networks also, if not in the same round, but in the next round, I think they try to raise it from the other network. So if I missed it somewhere as an investor network, I think then the same deal come back to us in the next round. So more or less, yes, you are right, Deepak. There are
And one
merits.
more thing which can be done. So let if I got any good deal which I feel that okay I want to invest, and if I am sharing that deal with my network, let I am with you WFP. If I'm coming to you, I'm mentioning you that okay there is a good deal, you should have a look, and if we can do something, then we can also bring that in our platform, right? Because I believe there is a guideline of AB to register an investor, right? So we have to make a commitment of 25 lakh rupees to invest in coming 5 years.
Yes.
If I am a LP or investor in 5 networks, then my total commitment would be 1.25 crore rupees, which
You're
is
right.
a very huge amount. So it is
You're right.
always better to closely work with one network. That is, I feel, so that is my personal observation or learning. So that
No,
I am
it's
sharing with you.
perfectly bang on, and I think Deepak, all the comments and I think all the feedback that you have shared are I think absolutely right. With every angel investment, if it is through an angel fund, there comes a responsibility and accountability of investing 25 lakhs over a period of 5 years. And that is the reason why people wants to stick to one, because the moment they switch to another fund, their responsibility and accountability of like making investment is double. So with that, let me just move on. So I have just listed here, okay, for the clarity once again, this is basically is my take that how normally typically an angel investor's journey looks like after like 1 to 4 years. And in the 5th year, they start thinking either take a bigger bets or they start their own network or family office or they invest in the VC fund. So one of these basically big leap is what they try to do. What we are offering, okay, now comes the recommendation part, Deepak bhai. So the recommendation is this. Okay, so what we are saying is that there are merits, okay, in taking a calculated leap right at the beginning. That while you are investing on your own, there are merit to also think of investing in a VC fund. And the reason basically is something that I'll share in the next few slides also. But one of the major insight and reason is that it is actually is the best way of diversification and hedging your risk and increasing the possibilities of returns. Because then if you are investing in a VC fund, and typically like the entry level in India by the regulatory for any investor when they invest in a VC fund is 1 CR. And typically funds take this money over a period of 3 to 3.5 years, and in sometimes even 4 years. So typically the money that you are investing in a fund is broken down into a yearly commitment of 20 to 25 lakhs. That is something that I have written in the bottom, that you can see that in our fund, we are taking this 1 CR in 4 different tranches of 20 lakh, 30 lakh, 20 lakh, 30 lakh in 4 years. But what this money helps you when you invest it through a fund, that your money is getting invested across the portfolio of the company that fund will invest. So that means that 1 CR money will be invested across 75 to 100 startups, depending on the fund thesis. In our case, like we will be investing this money in 100 odd startups. So your money is getting spread across 100 odd startups. So that means your portfolio that you can expect at the end of basically those 4 years is 100 company from the VC investments. And if you are parallelly investing on your own also small money, so whatever like 20, 25, 30, 50 startups that you will invest, I think that number, if you add to this, so you are talking about 100 to 125, 150 companies over a period of 4 years, where your money will be spread across. So in a sense, you are building a large portfolio of company by investing the same amount of that money, that say 1.5 crores to 2 crores that you're investing over a period of 4 years. So idea is, instead of waiting for that leap, okay, in the 5th year, if you do that calculations somewhere during this period when you are from 1 to 4 years, I think it is a better way to kind of like, again, going by the same fundamental of investing, of diversification and hedging your risk. And there are more logics also that we will be talking about in the next few slides. So one of the basically insight, okay, and this is why basically we are suggesting this. So this is a study that AngelList, which is one of the biggest and I think one of the most oldest platform of angel investing and VC fund investing. What you can see on this screen, this is a study that they have conducted on their more than 10,000 investors who have invested in minimum 10 to 100 startups. And the crux of this study is that size of your portfolio is directly proportional to the return. It is again a power law, as some of the theories conclude that more you spread your investments across the companies and better and bigger portfolio if you have, there are more chances of you making more returns. So what AngelList has done in somewhere in 2013, which was the first time, what they have started is that they realized it, that some of the people are not spreading the money, okay, and they are putting their money in few companies and putting bigger checks. So they were very cautious about this, and what they have done, they have created a fund called Access Fund. And the idea of Access Fund was to invite only those serious investors in that and give them a leverage of hedging that money, is the same money in across a bigger portfolio. And what you can see in this slide is that every year from 2013, 14, 15, 16, 17, every year they launched Access Fund, where they invited only a few limited partners, a few investors to commit minimum once a year in that fund. And once they started investing in this, so the density, the probability of people getting a better returns is depicted in the orange. And you can see that with every year, the percentage of the people like who are making more returns were the people who were investing through the Access Fund. The blue bars that you see are the investors who have not invested through the Access Fund. They have invested on their own by picking and choosing companies of their own, and they created their own portfolio. Versus orange is the depiction of those people who have invested through the Access Fund. And this is over a period. So you can see that consistently over a period of every year they have done this study, and this is the result. So this is like one insight that I wanted to share, that why it is advisable to take the blended approach. You keep on investing in companies on your own also, and you should also invest through the fund. Another analogy of the same thing, okay, I don't know whether it is very relevant or not, is in the listed equities. For example, we invest in stocks directly also, but we also feel that we should also invest through the mutual funds. So the smarter investors, okay, take SIPs also, they take mutual fund, big say investments also, and they also pick up their own stocks, and they also hire at times the PMS professional agencies to manage their accounts. So it's like a blended approach within the listed equities is what I'm highlighting. And a similar strategy is something that you can take while you are talking about investments. Another theory, okay, and this is again a study across different startup capitals. And this study also highlight the fact of having a large portfolio, which is increasing the chance of a big return. So this study talks about that. This was basically a study done on discovering a unicorn, that how much investment or how much basically what should be the size of your portfolio, how much investment that you should do across startups to discover the one big unicorn return. And that number is 50. So that means if you are investing across 50 startups over a period of time and you build your portfolio carefully, the chances that at least one of that startup will go and become unicorn and can give you a multiplier which can balance your entire portfolio. So whatever money that you invested, I think there are hundreds of such examples that you must have read. But the insight that I'm basically sharing here is that how to reach to that level. So that means if you are thinking, if you take this 50 as a number, okay, to kind of discover one good, okay, big multiplier. It may or may not be a unicorn, but I'm talking about one big multiplier. And this is something that I've seen in my personal portfolio also. This is something that I've seen in most of my friends who have invested in last like 5 years and have more than 50 startups portfolio, that at least there is one startup which is an outlier, which is an exceptional ROI, okay, for them, and which is balancing their entire principal amount. In our case, it is Zip Electric. 5 years back, I was the personal curator of that company. I invested in their first round. Some of my friends on my advice invested in that company at a $3 million valuation 5 years back. Today, they are raising at a $300 million valuation. That time they were pre-revenue. Today they are doing almost 3.5 to $4 million per month. $44 million ARR is what they are hitting, and they are operationally profitable. So at least one company I can talk about, okay, because this theory is not just a theory. I'm talking about my personal, and some of you who have invested in those many startups can kind of like, I think, endorse this, that yes, there are like one or two companies in your portfolio which has almost basically that kind of 70, 80, 100x, okay, of the return. So going by this theory also, if you see in first 4 years, if you are investing just through angel investing route, your portfolio will be 25 to 50 odd companies. While if you're investing through a VC fund, it will be 100. But if you combine these two, both the approaches of you picking up some good companies and investing through a fund, your portfolio is like 150 odd companies. And then I think going by this theory, they're like 3x, okay, more chances of you hitting to a unicorn. I will definitely take your views because I think some of you may be having some comments and remarks on these, but let me just quickly go through this and I will open the floor for your comment. Another reason why basically a lot of people, okay, give this thesis that the best deal goes to the VCs, okay. And two reasons that you will hear from people are these two, that people feel and founders feel and the ecosystem, okay, the perception is that because VC can guarantee a multi-stage funding, so the founders prefer to take money from VCs. And the second basically that argument, okay, or the perception is that they have a bigger network effect because they are like funding a company in say 5-6 rounds over a period of 7 to 10 years. That means founders are more loyal, more stickiness is there, okay, between the relationship of a founder and a VC. These are two arguments, and this is right to an extent, yes. But it's maybe there is a twist here, and I think that also talks about the highlight of a blended approach. Now, this is the study, okay. Again, this is a recent, say, published article on TechCrunch, and this is a study of all the 845 unicorns in US and UK. And the results are very, very interesting. That the maximum percentage of unicorn in their portfolio is by not any VC, it is by the accelerator VC. So SV Angels, the Silicon Valley Angels, have 6.4% of unicorn in their portfolio. Y Combinator Accelerator Fund has 10%. And on the other side, the closest from the VC community who comes basically into this list is Sequoia, which has 2.8%. This means that there is no formula that one side of the, the fund instrument or the fund structures have it, which others don't have it. But the fact that if you have a strategy, which is a blended strategy and a large portfolio, and you're spreading your investments as YC and SV angels, they spread. Their model is they have a fund, but their model is almost like an angel. So they spread. So it's an accelerator fund approach. Every year, YC invest in more than 270 odd companies. So their money is spread across the companies, and that is the reason why basically over the period they have more than 10% of the total unicorns which are there in US and UK market. With that, I come to the last one, okay, very important one, okay, and this is something that we have learned hard way in our own journey also, is the importance of a deep due diligence. On the screen that you can see, the red is the multiple that people have got, okay, when it was a low diligence startup deal. And blue is the case where there was a high diligence, okay, that means more time was involved, more man hours were involved in the diligence, okay, in the analysis, in the selection process of that particular company. And then you can see on the x-axis is the multiplier. So from 1 to 1.5x, from 5x to 10x, from 10x to 30x, and over 30x. And you can see that as the multiplier, okay, keep on growing, and we see the companies which have given bigger multiplier, you can see that the diligence was much more. People have actually gone very deep into the selection process before they invest. So that means it highlights the fact that a very deep due diligence is required. In our case, we have made some very big mistakes also, because problem with the angel funding is angel networks and angel funds do not have so much of time that they can hold a good deal. If it is a hot deal, it gets funded by someone or the other in the ecosystem. And as Deepak was saying, that the same deal goes, if it is a hot deal, goes to multiple investor networks and angel networks. And that is a reason why if somebody is so excited about the opportunity, they will immediately commit within a week or 10 days time or 15 days time, just doing the basic hygiene of that company, somebody will invest. And that puts pressure on the rest of the angel funds to kind of either commit fast or also basically follow the same practice. And that is why at times, because you're not getting into a deep due diligence, you lose on this part, okay, you lose on the crux of that deal, and there is a false outcome that you get out of it. And this is one of the reasons why VC funding, where it is a deep dive, okay, and they have time, because founders stick to their requirement, because they know that if they invest, it will be an investment for at least 4 to 5 rounds, multiple stage funding, large checks, so they cooperate more. So that is the edge basically that VC funding has over angel funds, and this is a very important insight that I'm sharing with you. So after covering all of this, okay, I just wanted to complete. There are endless, say, study and insight that I can share with you, but I just want to complete it here. And this is very high level overview, but still basically I try to see that can I share the most important part of this decision making. So if I want to summarize this, okay, that what should be the right winning formula for an angel investor like me, myself, or people who are there on this call, is a blended approach of investing both as an angel and as a limited partner in a fund. Try to invest in a fund which is taking an accelerator approach, early stage investing approach, where they're investing in large set of companies like YC and SV angels, and create a large portfolio of 100 plus companies, and still stay strong focus on DD, the due diligence part of it. So if you are doing this, okay, and you are preferring, and the fourth part, again, I already mentioned it, that try to invest in a VC fund which is taking an accelerator fund model. That means investing in the bottom of the pyramid, early stage, first institutional check, a bigger portfolio approach. So we are working very closely with SOSV, which again invest more than 150 companies in a year. So we have seen their success ratio also on a very high side. So that's the insight from my side. And based on this is the fund that we have created, Avanya Ventures. And the idea is to make 100 investment, again, go by accelerator model, and try to create 25 winners out of this and 5 mega winners. This is what is the basic, say, DNA of our investment thesis. And this is exactly what we have done as an angel fund till now. In last 3.5 years, we have invested in 130 companies that I shared in the beginning. And today, if you ask us that, do you have the clear winners, 25, 30 winners in your portfolio? Yes, we have. In fact, after this call, we will send you that portfolio to all of you to review that in last 3 years, after careful selection and investing, have we reached to a portfolio which we can call as like a winner companies. And if you believe in that, then I think you can yourself make your decision that what should be the next step. This is exactly what we are trying to do with the fund. This is the last thing that I want to share with you, that how we are ensuring that we will be able to get 25 such winners, and how is the probability is much, much higher, how we are ensuring the better ROI. See, the problem today that we are facing, that despite the fact that we have a clear 25, 30 companies out of the 100 odd investments that we have done, as an angel fund, we do not have the capacity to invest in their future rounds. Because we are an open-end fund. We do not have a fund which is committed to us and it is kept with us so that we can take decisions to invest in the further rounds of our portfolio companies. And that's a problem with every angel fund in the world, that they can invest in the first few initial rounds, but I think post, say, maybe 2 or 3 at the max, they won't be able to invest. Their model is that they have to keep investing in the early stage, okay, the newer companies, and keep basically taking them to the maybe 1 or 2 step further, and that's it. The difference that we will have after 3 years, the next 3 years, if I can predict, is that we will reach to somewhere here. If you can see this pyramid, we will be investing at the bottom of the pyramid in 100 companies, smaller checks, 50 lakhs to say 50 lakhs on an average. So in some companies like 50 lakhs, in some companies 75 lakhs or so, in 100 odd companies. That means by investing that much, we will be just exposing our 10% of the money, because our fund is a $60 million fund. It's a 500 crore. So imagine 50 lakh into 100 companies is just 50 crores. So just 10% of the money we will invest to discover the companies, okay, and to get a foot into their venture. And we are expecting that 40 companies out of those 100 companies will go to the next level, where we wanted to invest in their next slightly bigger check. And that check will be around 500,000 or 4 crores. So you can imagine that 4 crores each in 40 companies is 160 total disbursement. So that means in the first 2 bottom of the pyramid stages, we will be staying with the company for 3.5, 4 years. We will be investing in 100 unique companies and then doing at least 1 more round in 40 companies. And by that time, we will be exactly the same stage where we are right now through our angel fund. But the good point is, and the good news is, that by that time, we will be investing only and disbursing only the 38 to 40% of the fund. That means 60% of the fund will still be with us to invest in only those 30, 40 companies from there onwards. So you can imagine, out of the 500 crore fund, 300 crore is still left with us, which we can invest in those companies. So that's the investment strategy that we have created for ourselves. This is the learning of all our personal investing in the last 7-8 years. And I think the 3 years that we have invested through the angel fund. And this is exactly what the crux of that I try to basically share with you. So that's the journey. In case, and the bottom, you can see that I already mentioned it earlier also, that in case somebody is investing in this fund, that minimum investment commitment is 1 CR, but that we will be taking over a period of 36 months or 40 months. So that means the investment exposure to any investor is only 20 to 25 lakh a year. First year, we are just taking 20 lakhs. And then after 1 year, we'll take 30, and then 20, and then 30. So over a period of 3.5, 4 years, this money will be spread across. So that's on the return side. That's the strategy side that I shared with you. I think I just want to hold my case here, and I want to open the floor for an open discussion at this stage. Yeah.
Hi, Neeraj. This is Shovan here.
Yeah. Hi, Shovan.
Yeah. Thanks for the excellent presentation. I have quite a few questions. And yeah, I am not an investor, but I am closely following all your investments, all your presentations. Quite insightful. So the first question is that when we are comparing a angel fund versus VC funds, apart from the ticket size, for angel it's 25 lakhs, for VC it's 1 crore. Apart from that, I mean, do you see there are more advantages of investing in a VC fund apart from the larger ticket size, given we have already seen that the portfolio companies have seasoned and there is some track record, and the chances of them being successful is higher than investing in a nascent company through an angel fund?
See, to an extent, yes. But as I told you, the whole thesis of selecting a company, actually, when we are selecting, like, for example, if I talk about myself and for anyone, basically, for like, if you are the person who has to take a decision that whether to invest in the same company, I'm talking about the same company. If the same company comes to an angel fund versus it goes to a VC fund,
Yeah.
The chances is that in case the VC fund wants to take a decision, he will get a better, say, due diligence time, okay? Because in the startup also understand the fact that in case VC is committing a money, that money is not only committed for this round, they will keep on investing in at least like 3 to 4 rounds. And that is the reason why they wanted to support the whole due diligence process, okay? So the vetting which is done at the VC end actually give them a better insight about the decision making of making the investment. So that's one of the biggest, okay, advantage of VC have. Versus if you have if I'm thinking it from the investor's perspective, there are chances that at angel level the due diligence is not too much, and it's more on the excitement and I think the buzz and the hype that is created around that particular company. And that is the reason why there might be a chance that certain important aspect of the selection process actually has been overlooked just because of the the nature of the angel fund. It is nothing basically that I'm blaming anyone, but the whole point is the nature of the business is like that that's a basically flip side of angel investing. And that is why what we are offering is not either one solution. What I'm recommending is that if in case you can manage that, you can have the blended approach, okay? Pick up only, say, if you're investing as an angel investor in 7 to 8 companies in a year, what I'm saying is that put at least like half of that money into a VC fund, because there again you don't have to put all the money in one go. So over a period of next 3 to 3.5 years, 4 years, you have to basically give that money. And instead of like taking 8 decisions yourself, trim it down to 3 decisions in a year, and rest of the money you can commit to the fund, which will take almost basically 20-25 investments in a year. So your money is spread across the same money every year. Instead of like in 7-8 investments, it will be spread across 25-30 investments. That's the edge that we see.
Right. Yeah. And generally speaking, the companies which come to VC, are they more mature than angel funds? Or there's nothing like that?
So it is about the thesis of the VC fund, okay? If the VC fund, like for example, I've shown you that bottom, that pyramid structure. Yeah. So
okay, if it's an accelerator one, then it could also go for a very nascent stage.
Correct.
Okay, got it.
But
okay, and now, sorry, please go ahead.
Most of the VCs actually, they take a safer route. They feel that I don't want to invest in the bottom of the pyramid. Let somebody else invest in, and that somebody else is either the angel investor or a angel network or an angel fund. So they feel let them invest, and I'll come into the company only when there is a proven product market fit, or there is some kind of like a very credential, okay, of the companies are already discovered, or only then I will invest. Okay, so they are ready to pay the premium of the valuation just to hedge the risk. Okay, but I'm saying this is also is a problem of, because they do not have that kind of bandwidth. Most of the VCs are operating with only 4 to 5 investment team members and 4 people cannot make 100 investments in 3 years, because you need to like evaluate 100 company to make one investment. I think they do not have that strength. Only a accelerator fund which is working on a community approach. So see, YC is a community approach investing. They have a huge founders, alumni, founders community, which is giving them great references, great. Every YC company that needs to apply has to have a reference. So their reference system is so important. Okay, the founders backing founders. Okay, ecosystem that they have developed is the killer actually in the entire thing. Same is with angel networks, and I think we are taking the same strengths in our journey, that whatever community that we have built, we are taking the strength of that into the VC fund that we are doing.
Okay. And for Avinya, what is the size of the fund that you are looking at?
So it's a $60 million fund, 30 plus 30. That means in Indian currency, we are talking about a 500 crore fund. We are already at halfway mark. So $25 million is already committed. And we will be announcing the first close in few weeks time itself, and we'll start deploying the money. And then in next 12 months, we will complete the remaining round.
And there will be a division of commitment from the LPs and the GPs, right?
Yeah.
And what is that?
So GPs will be investing anywhere from 10 to 15% of the money, and rest will come from LPs. And LPs can invest anywhere from 1 CR onwards. So right now, if you ask me, the first 25 million that we have got, the check sizes from the LPs varies from 1 to 5 CR, most of them. So almost like 80% of the money is in that ticket size, and only 20% of the people actually has invested more than 5 crores.
Okay. And among these LPs, is there any kind of institutional investors?
So in a typical, say, first fund, when we think of bigger institutional investors, they come at the last stage. That means right now we are talks with some of the biggest one, the fund of fund, okay, and the usual suspects like SIDBI and all. So we have very good positive response, despite the fact this is the first VC fund, but they know that we already have 2 angel fund, and from there we have made more than 100 investments. So people are very confident about us, but I think their commitment will come as a last. So once we reach to say maybe 30-35 million dollars, so I think the last 10-15 million dollars of institutional money will come at that stage.
Understood. Okay. And when you
just 1 second, Shovan, because some of the people are
yeah, definitely.
they no, not you, but they are messaging me that they might have to leave, so they are asking me that in case you want to run that poll of commitments, so please do that. So Rohan, while we are taking questions, can you just also have that poll going on, so that people can at least like share their interest? And as a next like follow-up action, what we will do, based on the feedback that you are giving through this poll, we will reach out to you for a more larger discussions about the opportunity one-to-one also. That is the reason why we are just offering this poll. Yeah, so you can go on. Yeah, Shovan, any more question if you have?
Yeah, so when you mentioned that VC funds get to participate in the next round of investment, so is there like a right of first refusal clause that you sign with the investee companies, or how does that work?
So there's a concept of pro rata rights that we have to invest in the company. So that is a minimum commitment that we take from the companies where we are investing, so that we have a right to invest in the next rounds.
Oh, got it. And generally the GPs will be participating in the boards of these investee companies.
Yes. So that is a practice that I already mentioned in the slides also, that we push for a kind of like a board seat or a board observer seat, in the ventures that we are investing in. We still get that right while we are investing from the angel fund, but I think in the VC fund, it becomes very important discussion point here.
Understood. Okay, that's all. Maybe we can talk later on some further details. But yeah, thanks again.
Okay, so a couple of questions I have on the Q&A also, but I prefer if you can ask your questions directly here, just by unmuting. All of you have the right to ask questions here.
Oh,
Hi,
hi
Neeraj.
Neeraj. This is.
Yeah.
Oh, you can go ahead.
Uh, you mentioned about different level of due diligence being done by VCs and angels.
Yeah.
But at the seed stage, you can only do so much of due diligence. If you can explain a bit about what difference of what would be a different due diligence, or how deep you would be able to go when it comes to investing through VC, particularly for a seed stage.
Yeah, a very relevant question, Mukesh. So it's like this. The due diligence is on 3 levels. Okay, typically. Okay, so one is on the legal side. Okay, where you want to get very deep into the um, check and balances about the founders, their pedigree, the kind of work that they have done, and they're claiming. If they have set up a venture in past, you want to get into that also. Without naming a company, I'll also explain you exactly the case study. So one is that legal part. Okay, the second part is where you wanted to get more insight about the possible outcome and the projection that the company is offering. Okay, so you want to really to go deep into that. Okay, understanding that the kind of projection. Okay, the kind of industry, okay, trends that somebody is claiming. Like, for example, you are building your own company. If that company is in, say, for example, AI, and now AI is very difficult to understand that how much of impact of that technology or solution, or the early traction that you are already having, how much of that impact, okay, is the multipliers that you are promising, the valuations, okay, multiplier that you are promising, the kind of market capture that you are promising, are they realistic? So even if I have to go into that detail, okay, I need a lot of, like, I think multiple level of discussions with you. I want to go and want to check the customer base. I want to have a call with your existing investors. I want to go back and check with your employers, your peer groups also, just to get a sense of that, whether you are the person where I will at some stage will put a 10 million check also. Okay, so those are things which is um, not possible at an angel level. Okay, because you can do a basic hygiene check. Okay, and then beyond a point,
Right.
then you start getting that pressure of committing fast, otherwise somebody else will commit and they will lose your, okay, opportunity.
Okay.
So those are the things, and this has happened with us. Okay, in recent times in 2 deals where we have committed the money was there in our account. Okay, and then we got to know about something that we have missed in the initial due diligence. Okay, and it was not an information that we have missed. It is the information that surfaced, basically not about the current venture of the company, but the previous venture that founder actually has created. There
Okay.
was some issues, okay, with the previous investors, and I think the settlement that they had, and that was very difficult to gauge at the time of due diligence, and little bit of time that we get only to evaluate that company. And as a result, what happened then, we had to stop that money. Okay, we have to return that money in one case. In the other case, it took us almost like 3 months extra just to kind of reinvestigate the entire case from the lens of that we wanted to go so deep into that previous company. Okay, diligence, um, because it was such a big, like, lesson for us. So these are the complexity that comes into the due diligence.
Understood. And means of doing this extra due diligence is because the size of the fund is larger when you are going for a VC fund, and thereby you can deploy more resources.
Yeah, that's one. And second is also, as I told you, I'm again highlighting the fact that I think it's also about the intent of the founders. If they know that I am investing only, say, 1 crore in your company, and I may not be able to invest in your future rounds, then at times they will stop basically cooperating beyond a point. Okay, when I am asking for more details and more data and things like that. And then it becomes a problem. Okay, because then we come to a crossroad that how much to basically go into the, okay, due diligence, and that's the problem that we normally face.
Understood. Thanks. This helps. Thank you.
Hi, Neeraj, Dhuman this side.
Yeah, hi.
So my question is more towards the risk associated with the investments, and that is not from the startup point of view, mainly from the angel network through which we are investing point of view. For example, if we invest in the public market, uh, we do have SEBI and all for safeguarding our investments, but what is there in for the private market?
Okay, so risk is definitely there. Okay, no doubt about it. This is one of the most riskiest asset class, and I think it comes attached with the reward, the kind of. And you must have seen. I think there are so many studies, okay, on internet that you can find that VC actually has outperformed the public market, okay, over a period of time, okay, both in US and outside US, in emerging markets, and I think in developed markets, both. So historically, I think that has been the trend, that VC market returns has kind of like outperformed. But there is a risk associated with it, definitely. Um, that comes along, I think, as a nature of this asset class. So, and that is the reason why you have to be more careful about your investments. And that's again basically one of the reason why we are saying, and I think we are coming to a conclusion, that you don't basically stop choosing companies on your own research and your own gut feeling, and I think on your own selection, but at the same time just try to hedge this and put some money into the VC fund also. Let professionals also do some kind of investing on your behalf. So a blended approach is what basically we are promoting.
Got it, got it. By the way, my question was more towards the risk associated with the angel networks, not the startups. So for that,
So see, I'm talking about the angel network itself. Okay, so see, if you're investing through the angel network, see, it's like this. Either what options you as an individual have. One, you pick up, okay, companies on your own. Second is you do with the collective wisdom and you join a investor network where others are also taking a decision, and you can also hedge your risk through that collective wisdom and group investing. What is the third level? Where you invest it, okay, through the VC fund, where more professional approach is okay. So these are three options in front of you, and with every say options, there are risk and reward proportion which is okay, that you need to calculate, and based on that you can take a decision. So with angel network, if you compare it with your individual picking, I think the risk is slightly lesser. With VC fund, it's become even lesser. So that's how it is.
understood. Another follow-up question is more towards the investment thesis at the early stage. For example, you have given the example of Zip Electric. Uh, could you share some insights, like what made you bet on that stage? You told it when you invested, it was a pre-revenue stage. So, what is different in your team while you look at the investments in compared to some other players in the market? Because at the early stage, it's all about betting on the founders or having that well-established network to get the deal flows. So, could you elaborate a bit on that aspect?
Sure. So a couple of things, okay, not one thing that I can pinpoint. Okay, when we were investing in Zip, I think we were taking bets basically in the same year with 20 more companies, and I think we have not done anything different in Zip, okay, that we have not done in other companies. Okay, having said that, some of the things actually that makes you wise is the network effect of your investments. Like today, if I reflect back, we were the early say investors who started backing EV companies. Today we have 10 EV companies in our portfolio out of the 120. And these 10 investment basically is a result of the good returns that we have got from some of the early investments and the strength that comes with those companies. So Zip today is not the only company. We have invested in Blue Smart, we have invested in Kazam, we have invested in 10 more companies. Now, with every investment that we are doing, we now have a better intelligence about that sector. Those founders are bringing more strength in terms of the wisdom and insight about that sector. So we have become, in a sense, basically a sector expert in that particular sector, just because of the kind of continuous investments that we have kept on doing. And that was a result of basically one good investments, and that has given us confidence to like invest in say one more and one more. And on the other side, that has also given us a network effect from the founder's side. Now, any founder who is doing something in EV wants to come and take money from us because they feel that that money will also bring those access to those successful founders and their business. So now that network effect between founders to founders is also working in our favor. So One is that intelligence, and that comes with, I think, over a period of time, and every fund has over a period of time actually developed their own thesis. Okay, there's few sectors where they have better intelligence, better gut feeling also at the same time. Based on that, they are making decisions. Yeah, and there is a hedging, say, ecosystem that they have. So in our case, I think communities are a hedging formula. Wherever we are not able to take decision, I think and in fact, in every selection, we bring community. Like just before this call, we were evaluating a sports tech company, and we invited 8 different people, okay, coming from consumer experience, D2C, and sports, okay, background. And they were the people like who, despite the fact that we were very bullish about the company, before taking a decision, we want to involve the community. And that is basically one of the ways how we are hedging it. So the secret sauce that you were asking, that what we have done differently, is that we have not just relied on our own decision making, but we try to make it more democratic and involve more people, okay, into the decision.
Got it. Got it. Thanks for all the suggestions.
So I think in the interest of the time, we have just last 3 to 4 minutes. We can take 1 or 2, 3 questions.
Hi, Neeraj. This is Radhika. A small question: how involved are the LP once they have made the investment in the other than the selection of the startups, and what is their involvement?
So, say involvement is in. So we have like 3 phases of investment life cycle. Okay, one is before we make a investment, which is like curation, due diligence, the scouting of deals. So that's one area. Once we make once we find out a good company, then the second piece is the investment itself, and third is post investment, where we start working with the founders and help them into the venture building. So these are 3 phases, and I think we try to involve LPs in all 3 phases, both in scouting and selection process, and I think the post investment venture building stage.
Okay.
Maybe it's just a follow-up on that question from Radhika. Involvement and influence from LP. What would be, what kind of influence LPs have in the selection process?
Not any influence, not an influence, but it is like this, as I just mentioned. Like for example, tomorrow if I'm evaluating a space tech company and we do not have that strength within the IC or within the fund, I think it's the obvious, say, wiser decision is to go to your community and find out some SMEs in that area, or some of the founders that we backed in that space, to invite them into the decision making, have a discussion with them, and try to make it more structured. Like right now, when we invite any domain expert, it is not just a casual invitation that we are doing. Mm-hmm. We tell them that what is the expectation that we have from them, how much time that they have to give while they are coming in that call, and post the investment and pre-call and post-call, what is the basic minimum obligation that these guys have to fulfill, both in terms of like structured feedbacks, and once we have taken a decision, they have to sign a MOM also. So those are the basic like check and balances and expectation that we put on them. And similarly, we put ourselves also accountable. We are not inviting them just basically as a casual way. We send them all the IC notes that we have. We share the summary of basically the IC notes, that this is what we think about this company, and these are some of the details, and just please go through it. And only once basically you're ready, then we invite them so that they come prepared in that call. So those are some of the things that both side, okay, it's not one way that we are making them accountable, and we are not basically doing it in structured way, but there is no influence as such, okay, from those guys. Yeah.
Okay, thanks.
Right then, I think with that, thank you so much everyone who has joined us. We have your I think all of you have taken the poll. If not, please do that so that we know that what to do as a next step. If you want more information, we'll definitely come back to you. If you want a one-to-one session, we'll definitely set up that. In case you have made up your mind, thank you so much. So once again, we have that in front of you. Please take this poll in case you have not taken it.
Neeraj, is this part of WFC or is it Avigna separate?
So it's the same group company. This is like one more venture from us only. Subhashini ji, it is from the group company only. Same set of people.
Super.
Neeraj, how will be the allocation of funds from LPs? As you have mentioned, it will be over 3 years. So how it is going to be?
So 4 tranches, 20%, 30%, 20%, 30%.
Okay.
Yeah. Okay, so thank you so much for taking the poll and asking those questions. We'll keep doing these sessions every fortnight. In case there is any further question, now that we have your contact and we have your I think feedback also, we'll definitely come back to you. So me and my team will be in constant touch with you. Thank you so much. Have a great weekend. Yeah. Thank you.
Thank you.
Thank you.